The problem with it is right now in this market, interest rates are so high, we can't do the BRRRR strategy as often. So the renovate, refinance, repeat side doesn't have as much savoriness unless you have almost no debt on your portfolio. I see Kevin, he's like looking at me like, yeah, but what I could do it. You could do it. I could do it because we have paid off buildings. So refinancing still can make sense if your buildings are paid off. But if you already have 60% leverage against the property, it doesn't really make sense to go higher on that leverage mark. I don't like going over 60. Write that number down, please. Because I've talked a lot about a lot of things, but I don't like going over 60. I certainly don't like going over 75. 75 would be a red zone for me. I do not ever like to go over a 75% uh, debt position or LTV, but 60 is a sweet spot. When we hit 60, I'll push up to 70, maybe 75. But if I hit 50 or 40, I'm concerned I want to get back to 60. Write that down. Just think of that as a good equation to say I don't never want to be over leveraged, but I also don't want to be losing return on equity. I don't want to be losing the return on what's sitting inside my property. That in our heads, we start evaluating properties. So if you have a single family home, show of hands if you have at least one single family home, whether you live in it or it's a rental or it's a condo or something along those lines, a townhouse, something like that. You have one single family home. You want to look at that, look at its equity, and then ask yourself, what could I do with this equity? If I sold it, because here's my pitch to sell. I only own 12 buildings. Now I have 12 condos. I have a 80 I have an 80 unit building in Jackson that has 13 buildings technically. There are technically 13 roofs on that portfolio. We do own 15 roofs, 15 towers in Cleveland across 10 separate sites. Actually, they're not 10 separate, it's 7 separate sites because some of our buildings are side by side with each other. So the sites are actually reduced. So there may be 15 towers across 7 separate sites. In Decatur, Illinois, we have 4 buildings, but it's 35 units. But it's one single site. So singular site is a lot easier to manage than having, let's call it 580 single family homes. Who here can grasp that's a lot of roofs, a lot of addresses, just a lot of everything to remember. I can now from the 13 buildings I have, I can dial it down. It's that one property. We call it Blue Haven in Jackson, Mississippi, one property. And I can dial it down to one of the 13 buildings. So we have listed from A to M, 13 buildings. And then I have my units. Either there's 4 to 8 units inside that building. So I have unit D12, D8 tells me which building at that site. So I can do property address, and then D2 tells me exactly what unit that is. So I think that's a lot easier than having the whole address of every single property all across the country, the different states that it's in. So what this philosophy of peer bidding does is think about it. I'm across 10 different sites. My whole portfolio is 10 sites, but 508 units. If I sold way back, I used to sell a single family to buy a 3 family. And then I would sell 3 families to buy 6 units or 12 units. And I would sell. It got to the point where I was selling condos, and condos were buying me 6 family buildings. So I could sell a condo and buy a 6, sell a condo, buy a 6, sell a condo, buy a 6. And then I get to the point where right now I'm doing a refinance, and I just refinanced $1.3 million, and I'm using that as a down payment to buy 380 units. So I can keep my 12 units and roll them into acquisition of 7 different sites, or a total of 380 units. That's called pyramiding. The simple philosophy of this is I'm reducing the amount of places I have to manage while increasing the amount of units that I own, and that equals the amount of cash flow that I'm getting. Units are not important in some capacity, but in my world, 500 units, I do a rent increase of $50. That's a significant increase in revenue into the portfolio every single month. In fact, the revenue increase of $25,000 a month. Who here would love an extra $25,000 a month? Just from sending a notice to your team and saying, hey guys, everybody goes up $50 this month, which is reasonable inside this portfolio. So every year for the next however long we hold these portfolios to increase $50 a year, that means these 500 alone are going to increase $25,000 a month. That's $300,000 of revenue that increases without an increase of tenant base, without the expense of extra tenants. Regardless of the market conditions, that will likely to be what continues over the next couple of decades. Who here loves the idea of units in that capacity. Now, the same thing as in my condos. In my condos, they go up $100, sometimes $200 a year. So, well, this year they're going to go up 200, but last year they went up 100. So that's 12 times 200. That's $2,400 a month. That's almost $30,000 extra at the end of the year. So units, if I had one of those or I had 10 of those, make a difference. Show of hands, you agree. Units do make a difference. Once you've committed to your market, then all you can do is increase units, increase units, increase units, increase units. Now, if I compare the Fall River market, those units that are renting at $2,000 to my Cleveland market, those units are renting at $750. Those are not created equal. And that's where the unit game doesn't make a lot of sense. It doesn't make sense to compare units from different markets. I bought the Fall River units at $34,000 a piece. They're just now appraised at 200 and 228 and 250, some of them. The Cleveland market, I bought those at 38,000. They're appraised at 65,000. So there's a huge difference in what the value of a unit is. But once you pick your market, then it matters. Who here agrees we're going to pyramid in a singular market, so it matters. Now, one thing you can do, I just shared, you can transfer units at high appreciation markets. So if you transfer a unit out of, let's say, my Fall River portfolio, I sell a condo. That one condo brings me in, my average rent's 2,000, so it brings me in about 24,000 a year. And I sell it and I take it because they're paid off. I sell it and I take it and I take that $200,000 in equity and I put that into a building that is, let's call it a $600,000 property or an $800,000 property in Cleveland. That property, let's say I pay full price for it. That $800,000 bought me 40 units. I'm sorry, 20 units. 20 units in East Cleveland. 2 times 5, $1 million plus my 200s in there. Yeah. So we got 20 units in East Cleveland, and I've now increased my rents 750. Just let's say average rent that I have 750. That's $15,000 a month. Oh, who's catching this? I took a condo that was earning $2,000 a month, and I went and I bought a 20-unit building that's earning $15,000 a month. Same dollar amount is the same. I have the same amount of equity. I just moved it from one building to the other building. Let's say I did a 1031 exchange. Just moved from one building to the another building. I take a condo. It's 1 unit. I buy 20 units. Could I buy anything else in Massachusetts? Could I buy a property in Fall River that's going to bring in $15,000 a month, my $200,000 down payment? Show of hands if you don't think that's possible. Not possible. Not physically possible. So when I say units matter, I only mean in this respect. I don't mean in ego. I don't mean in like, oh, they got so many units. Look at how cool they are. What I mean is it matters in cash flow. It matters in how much I can raise rents. It matters by how many people I'm diversified across. It matters by how much leverage I have in income. So a $200 return on equity that was pulling in $30,000 a year could be shifted to a portfolio, let's say in Cleveland, we're using that example, that's pulling in $190,000, $180,000 a year. Who here believes you could change your life with pyramiding real estate? Who here believes most investors never consider this? That's right. You can be an investor 10 years, 20 years, 30 years, 40 years, and never have considered it. I think I'm lucky. I don't know why. I'm obsessed with spreadsheets. I'm obsessed with potentiality. So for some reason, my brain went a little sideways, and I said, let me see what this would look like if I did this over here. It wasn't overnight. It took me 4 years of living in Florida doing absolutely nothing but teaching. All I was doing was reading, studying, educating myself, reading, teaching, listening to other investors, and bringing people on my podcasts. And one day I woke up and I went to Doreen and I said, oh my God, you have no idea how much time we've wasted these last 4 years. We could have been pulling in, I told her the math was $100,000 a month of true cash flow if I'd done this right. Right now, if I had done things right 4 years ago, I'd be pulling in 100,000 today. It wouldn't happen 4 years ago, but it would have happened over 4 years. I'd be pulling $100,000 a month in true keepable cash flow. Why? Because I'd have $10 million lent out at 12%. Who are going to do that math? It's simple math, right? $10 million at 12%, that's 1% per month. That's $100,000 a month coming in. But I didn't make the right moves 4 years ago. I just didn't know. I wasn't thinking right. So here's the formula. Buy something in an appreciating market. Buy something that you know for sure can go up in value. Even if it breaks even if you cash flow just a little bit, even if you're in Florida and you lose cash flow a little bit on a duplex, buy something in an appreciating market, buy it well enough where even if the market does drop a little bit, because I do see sideways movement on the charts, I do see the possible for a lack of cash flow, not a lack of appreciation.
I
But
think I
buy
was
it
going to
well
make
enough.
hours.
What is it?
Sorry.
Oh yeah, good. Yeah. So buy something well enough Do your flip to hold. Do a hybrid strategy where you know you're in a market that's going to appreciate. There are some markets I think will appreciate. Boston. I think Boston will do well. I think New York City Metro will do well. I think Miami will do well. But I think that if you buy overpriced, you'll do wrong or you're going to get hurt no matter what. Show offense, if you buy wrong, no matter what, you're getting hurt. You have to buy them right. I do believe that there's a chance and an opportunity in certain submarkets of the major markets to buy a thing and improve its appreciation in a short period of time and then deploy that into cash flow assets. This is for the people who are sitting on some capital and they're wondering, should I deploy everything into these cash flow areas? Well, if you're old enough, yes. Right? If you're towards retirement, you're like, I just want to get out and not do anything. Yes, it might make sense to shift into lending completely, right? Eliminate just that whole space. But if you're looking to grow, and let's say you believe you mentally believe you're young enough to keep growing your portfolio, then it would make sense to drive into one of these markets that provides cash flow and buy it right so that you could force the appreciation. Then you could take that one day and lend out. Had I done this 4 years ago in Cleveland or Jackson, any of these markets, I would have the nest egg that I need to go and sell to make $10 million of lendable capital with a deferred sales trust. I didn't do that. I wake up every day knowing I didn't do that, and I wake up saying, how can I do that today? Who here's missed the boat on some things and is now waking up and saying, I'm going to do what's right for me today, knowing consciously knowing what the right move for me is. So here's the overview one more time of pyramiding real estate. Buy an asset that you can hold, that cash flows. Even if it breaks even or it's just a little bit, you have to be able to hold it for the long term. I do not want anybody underwater. Show fancy commit to never lose money. Never, ever, ever lose money. Excellent. So do not over leverage. I want you to, if you're going to buy these, I want you to not over leverage. I want it to be 60, 75% max LTV. Never go over 75%. And I want you to do it in a way that you could hold it forever. With that debt, hold it forever. It pays for itself. And then two, buy as many of those as you can in the next year or two. And then as they appreciate and get beyond the point of management, you go and you look and say, I got 10 buildings that I bought these last 10 years or last 2 years. I'm going to take them and I'm going to buy 10 buildings that provide massive cash flow, that provide retirement level cash flow, that provide life changing cash flow and depreciation and amortization. Some of you may take the easy button and some of you may say, I'm going to split half of this.